Zomato. Now that's the stock that everyone's been talking about. It's been a big mover over the last 12 months as well, right? You know, what's surprising is after its IPO and then the slump, this one's risen like the phoenix. In the food business itself, the company, while its revenue grew a little over 40%, the operational income, the EBIT, grew over 200%, and there was a near 1,000 basis points improvement in the food business margins from a little over 6% to around 16% itself. That was a positive. The second business, which is Hyperpure, which is a B2B business, has seen a near doubling of revenue. Out there as well, the losses have narrowed to just about 16 crore on the EBIT loss. Here's where the headline was. The revenue for Blinkit grew 111% in the fourth quarter, and that's not all. For the first time, it's actually went ahead and become EBITDA positive. So that's a big headline. Why is that? Because not only is the food business making money for them, the quick commerce business money, which is seen a fair amount of growth, is now money making for them as well. And that's not all. In fact, the company says that they are going to double down on the quick commerce vertical going forward. From about 520 plus stores that they have right now, they're looking to go there all the way up to 1,000 stores by the end of FY25. They're also looking to increase their presence in cities like Mumbai, Bengaluru and Hyderabad. The company believes if they go ahead and do that, they could actually increase the gross ordering value in Blinkit by 4 times just by doing that. But for that, they'll have to cut down on margin expectations for the next 4 quarters. And that's exactly what they said, that there will be near zero margins in Blinkit for the next 4 quarters because of this expansion that they're at. But once they do expand, steady state margins in this business could be anywhere between 4 to 5%. Now, the reasons why the stock was lower after the results. First things first, Zomato has already seen a big rally from lows of around 40 rupees sometime in the middle of last year. The stock has rallied all the way up to 200 rupees. So a large part of the easy money has already been made as per Jefferies. The second part, the company also, apart from increasing operating expenses for aggressive expansion, have announced an ESOP plan for Zomato employees. What does this ESOP plan indicate? That they will issue up to nearly 18, a little more than 18 crore shares to their employees, which at current prices amount to nearly 3,500 crore rupees or 2% of the company's overall equity outstanding. While they're rewarding their employees, and this is good news, from a shareholder standpoint, this may lead to higher employee expenses and may impact margins going forward as well. So increased operating expenses on the growth driver, which is Blinkit, and higher employee charges expected on account of this ESOP, with a big rally that we've seen in the stock price already, led to a bit of profit taking. But are brokerages worried about that? Turns out not, because the growth driver of the company still remains to be Blinkit. Nomura actually goes ahead and expects a 65 to 99% jump in Blinkit's gross ordering value, and at the same time they expect contribution margins of nearly 4 to 4.5%. Zomato's been trending, the numbers are doing extremely well. A few quibbles here and there led to a bit of profit taking, but most of the brokerages believe from a long-term standpoint this is a positive move, and they have target prices ranging anywhere between 230 to 290 rupees.